I'm an insurance guy, and I'm about to spend the first half of this video defending Dave Ramsey. That probably breaks your brain a little because you've seen this video 100 times. Agent fires up the camera, calls Dave Ramsey clueless, then conveniently sells you the exact product Ramsey warned you about. Not here. Dave is right about IULs far more often than my industry wants to admit. So I'm going to give him full credit. And then I'm going to show you the one specific place his advice falls apart. Not because Dave's wrong, but because you might not be the person he is talking to. Quick, for anyone new here, I'm Michael Ducille, the insurance architect. A broker gets paid to sell you a policy. I get paid to design the right structure, which means I have no reason to lie to you about Dave Ramsey. So let's be honest about him. So Dave's position has been the same for decades, and most of it's correct. Here's where I won't argue with him at all. He's right that most people should buy term. For the average household, get the most death benefit for the least money with term insurance, and don't tangle up your insurance with your investing. For most people, that's exactly right. He's also right that cash value is sold to the wrong people constantly. This is the part agents hate. Dave built his whole stance watching families get sold expensive permanent policies they didn't understand and couldn't afford to fund. He's not making that up. That happens every single day. I made a whole video on it. The scam version of IUL is real, and Dave is describing it accurately. He's also right about the order of operations. Debt, emergency fund, match, invest. Get out of consumer debt, build the emergency fund, capture your full 401k match. That's free money, nothing beats it, I get it. Then invest. If you skip those steps to buy any cash value, you got sold, not served. Dave's right. I'd send you away too. And he's right in spirit about buy term and invest the difference. For someone who is in those early baby steps, buying term and investing the gap in low-cost index funds is a perfectly good plan. I'll not pretend otherwise to make a sale. So if you came here to watch me dunk on Dave, sorry. For the audience he's actually speaking to, his advice is some of the most protective advice in personal finance. Here's the word that matters. Most. Dave gives one rule to one audience. The millions of regular households trying to get out of debt and build their first real wealth, that's his system. That's what his system was built for. And it works. The problem isn't the rule. The problem is when people with a completely different financial situation applies mass market advice to themselves. 3 places it falls apart. 1, the tax bill nobody in the plan talks about. Invest the difference. Usually means 401k or a brokerage account. Both build a future tax liability you don't control. Traditional retirement money gets taxed on the way out with required withdrawals starting at 73, whether you need the money or not, and whatever tax rates exist decades from now. For a high earner, tax diversification is a real problem, and buy term and invest the difference doesn't solve it. It just defers the question. The second thing, become self-insured, assumes a simple life. Dave's long game is that you build enough wealth to not need life insurance later. Beautiful idea for a household with a paid off a home, an index fund. Now, make that person a business owner. Suddenly there's a partner to buy out if you die. A key person the company can't replace. A tax bill your family has to cover to keep the business, and the legacy you want to pass without the IRS taking a cut. Self-insured doesn't mean a buy-sell agreement. It doesn't create instant tax-free liquidity at death. That's not a savings problem. It's a design problem. 3, the math leans on optimism. The just invest the difference plan tends to assume returns on the high side and ignores what a market crash does to you in the wrong year. Protection from a bad sequence of returns has real value, and its value the blanket rule doesn't price in. So is Dave dead wrong for the median household? No, he's right. For a high income earner or a business owner who's already done steps 1 through 4, applying his blanket rule to that situation can quietly cost them. Not because Dave failed, because they took advice built for someone else and assumed it was built for them. So let me make this useful instead of a debate. 2 questions decide whose advice applies to you. So you follow Dave to the letter if you're carrying consumer debt or you don't have an emergency fund yet. You haven't captured your full 401k match. Your financial picture is straightforward. W-2 income, no business, no complex estate. Honestly, that's most people. And there is zero shame in it. Term plus index funds will serve you well. Close the tab and go execute. Now, you've outgrown that blanket rule if you're a high income earner, you're a business owner, or a 1099 who's already maxed out your tax advantage accounts. You have a tax problem in retirement, a business to protect, or a legacy you want to pass efficiently. Self-insured doesn't cover what would actually happen to your business or your estate if you die tomorrow. If you're in the first group, Dave just saved you from me. If you're in the second, however, the question was never Dave versus IUL. It's, does anyone's one size rule fit a situation that isn't one size? Here's the honest summary. Dave gives you protective advice to a general audience, and for that audience, he's right far more than my industry will admit. He becomes wrong only when someone applies mass market advice to a situation that stopped being average a while ago. That's the entire reason I design instead of sell. A design starts with your situation, your taxes, your business, your legacy, not a rule made for everyone. That's the ARC method: asset protection, risk control, capital growth, and heritage planning. So no pitch, just this. If you have already done the baby steps and you're sitting there wondering whether the blanket rule still fits you, book a strategy call at designwhatlasts.com/strategy-call, or DM the word architect on Instagram. We'll look at your actual situation, and if Dave's plan is still the right one for you, I'll be the insurance guy who tells you, go follow Dave. I'm not here to sell you a product. I'm here to help you design what lasts. See you in the next one, where I show you how to tell if your IUL was built for you or for the agent who sold it.